Okay. Hello, everyone. Thanks for showing up tonight. I'm Debbie Schwartz, founder of Road to College and the Paying for College 101 Facebook group. And I am here tonight with Chris Abkarians. He's the co-founder of Juno, which we will share more about during tonight's conversation. Thank you. I see a few people who already put their video on. It's if you're willing to, it's nice to see people's faces. And this is actually technically a meeting, not a traditional webinar. And I only share that because you've come in muted. If you can stay muted, that's great so we don't hear background noises. But if you truly want to ask a question, you don't want to put it in chat, you can unmute yourself and ask your question. In fact, we have a few sessions coming up called AMAs, but I guess they should be ask that's ask me anything, but they should be AUAs, ask us anything. And we did them last year, and truly they were just people unmuting and asking their question, and Chris and I trying to help them. And so I only share that because those sessions are going to come up soon, and as people kind of get further into the loan process and they have questions, we found those sessions to be really valuable to just help people with whatever their questions are, and actually for other people to hear what their questions are and the answers. So, but tonight, Chris is going to focus on kind of the general process about paying for college. We are going to talk about some of the changes that have been passed recently with the bill through Congress. And he will also talk more about how Juno can help you. So, Chris, I'm going to pass it on to you to give people your background and get started. One last quick thing, please put questions in the chat. I will either help answer them, or I can definitely interrupt Chris, or we will answer questions at the end. But we really want to help you as much as possible, so please ask your questions.
Thank you very much for the intro and for putting this together as always, Debbie. And thank you everybody for being here this evening. My name is Chris Abkarians. I'm one of the founders of a company called Juno. Quick backstory. 7 years ago, I started becoming a reluctant expert on almost all things related to financial aid and student loans. I had just gotten into business school, and one of my classmates and I were researching and comparing student loan rates from different places. And we decided to try an experiment to see if we could bundle together a few hundred of our classmates who all needed to get loans at the same time, and then ask different banks and credit unions if they'd be willing to negotiate on the rates they would have charged us if this large group of people went to the same place. Some of them said yes. We made them bid against one another, and we were able to get a better outcome for everybody than we could have achieved alone. And for the last 7 years, we've just expanded that same concept to now almost all schools in the US, and from what started in just MBA programs to undergrad. So I'll tell you a little bit more about how we fit into the overall process. I'd like you to just think of Juno as a free option in your consideration set when thinking about how to pay for school, both this year and in future years. And really is just meant to be that one additional way that you might be able to bring down the total cost of financing school if you need to. And with that, here's a quick overview of what we'll go over for the next hour. So as Debbie was mentioning, I'll give you a quick overview on, let's say, some of the ways to think through paying for school. And we're going to spend the vast majority of the discussion diving into how undergraduate loans work. Within that, I'm going to walk you through how some of the changes that were passed into law last week would impact Parent Plus loans starting next year. And then I'll also give you a really brief 5-minute overview on graduate student loans and some of the changes that would impact what graduate students could borrow next year and beyond. We've got a lot of questions about that more recently from especially parents whose children might be juniors or seniors and planning on graduate school. And so there are some key things that you might want to be aware of. And then I'll give you the 5-minute spiel on how Juno fits into this entire thing and save as much time as we can for Q&A. As always, if there's any questions that you do have as we go through, please feel free to write them in the chat box, and we'll both monitor that as we go through each slide, and I'll pause anywhere along the way and answer those. If you joined any of the previous webinars, you might be familiar with a few of the initial slides, but I'd like to just add a little bit of context for the general timeline for financial aid and really where this conversation tonight fits into the overall picture. And so right now we're in the almost the middle of July, which it's going by more quickly than I expected it to. And so most people have already filled out FAFSA, applied to school, gotten into school, decided where they're going to school. And in August and September, for the most part, schools have tuition due dates. Really around now is when most schools start creating student bills. And those student bills typically have to get paid by a certain date, 30 to 60 days later. And this is the time period during which you may be deciding how to actually approach paying that bill. So tonight we're going to really focus on that portion of the conversation. If you have questions about other topics like still filling out FAFSA, which by the way, it is not too late to do, or understanding the results of that FAFSA, or about appealing financial aid awards, those are all things that Debbie and I have run previous webinars on, and that I'm more than happy to send you some materials about, or you can find links to the previous webinars, the recordings of those on Debbie's channel as well. So I'm going to start off with a pretty simple example that we're going to use throughout most of tonight's conversation. And it's important to frame this entire conversation with understanding cost of attendance, which is put simply the sticker price of going to school for 1 year at a time. The example we're going to use is an incoming in-state student at UCLA, somebody who's going to college this fall. And what you see in front of you in this chart is the fully loaded cost that UCLA publishes on its website to represent the combination of tuition and fees, plus their estimate of food and housing expense, health insurance, personal expenses, and books and supplies. When you add all of those things together, UCLA estimates that it would cost this student a little bit over $43,000 to attend school for this year. A few things that are just important to understand about this number. One, again, this is just 1 year at a time. It's going to change a little bit next year and the years after that. And two, a lot of people, your financial aid office has likely already communicated this, but you'll notice that health insurance line item in this cost of attendance is pretty large. It's $3,661. If your student is already covered under your health insurance, and most would be until the age of 25, then you're able to waive that health insurance, and that would meaningfully bring down the overall cost of attendance. And so your school has probably already communicated how to use a health insurance waiver. I would just double check and make sure that if this does apply to you, that you meet the deadline for submitting that waiver so you can bring down your total cost and you're not paying extra for something that you already have. Now that we start with this fully loaded cost, what we're going to do is just break down the order in which you'd go about paying it off. And so you're going to start off with scholarships and grants. And it's what the financial aid office is going to call other financial assistance. You fill out FAFSA once per year. For some schools, there's a FAFSA equivalent called a CSS profile. And those things help you get access to different buckets of funding, and ideally money that does not have to be paid back. So the first bucket of things that you can get will come from the federal government. There's other money that you can get from state governments, and some schools do have their own institutional need-based aid budget, which just means that they have money that they can give you in the form of a discount in order to attend based on the results of your financial aid application. Make sure that you've filled out FAFSA every single year, because you typically need to in order to access these sources of funding, and they can make a meaningful difference in the amount that you actually have to pay out of pocket. For the example that we're going to use tonight, let's just assume that this family got about $5,000 worth of total scholarships and grants. And so that's going to reduce their overall need to pay from 43,000 to about 38,000. This next topic, I'm not going to go into in a lot of detail, but something to remember is, for next year and beyond, is you have to fill out FAFSA each year. And each year, the financial aid office determines the level of financial need that your family has. There is an opportunity for you to appeal the results of that FAFSA and explain to the financial aid office why what they're telling you you need to pay is too much. They don't have to accept every appeal, but there are some detailed and specific reasons why you can increase the likelihood that you might get more aid in the future. And what I've included is a link in this slide, and as maybe one of the more popular webinars that we ran earlier this year, is a roughly 90-minute conversation about some of the tips and tricks and strategies that you might want to use when writing an appeal letter for the following year and beyond. And so maybe pay attention to that, because there's a lot more reasons that you can appeal than might necessarily be immediately obvious. And I'd highly recommend you give it a shot. Moving on, again, this example family, we started with $43,000 as the cost of attendance. After scholarships and grants, we're going to get to $38,000 that this family has to find some way to pay. This $38,000 number in this example is really important, because what it actually represents is this family's borrowing limit. Every school is required to cap the amount that a family is allowed to borrow each year at the equivalent of this number. And so it's always going to be whatever the cost of attendance is for your school for the year, minus the other financial assistance that you've received. Let's just say that this family had about $10,000 worth of savings that they were able to use for this year. And that's going to still leave them with a $28,219 bill that is left that they have to find some way to pay. And if they've tapped out on the savings that they can attribute towards college for this year, then that's an amount that would need to get borrowed. And so we're going to shift the conversation now to thinking through and better understanding the different options that you have to borrow for undergrad. And the three sources of money are going to primarily be federal loans that are borrowed by the student, federal loans that are borrowed by the parent, or private alternatives to the above. And so what I'm giving you here is just a really brief preview of what we're going to go through for the next 15 minutes. There's two federal loan programs that we're going to walk through in a lot of detail. And the first bucket of federal loans that you can use to pay for undergrad this year is called a direct loan. It has lower rates than the other federal loan, but you're not allowed to borrow a lot of money through the program each year. The second bucket of money from the federal government is called a Parent Plus loan. It has higher rates and higher fees than what the student can borrow, but currently it allows the parent to borrow whatever amount is needed to meet that cost of attendance. I'm going to walk you through some changes that were just passed into law that will impact Parent Plus loans for future years in just a few minutes. Then the third bucket, which we'll also go through a little bit later, is private loans, which are any loans that you'd be getting from a bank or a credit union or through a fintech lender or other sources. Those, similar to a Parent Plus loan, they let you borrow whatever amount is needed to hit your cost of attendance. But the rate that you'd get charged on these is going to vary based on the strength of your credit profile and the general market overall. For each of these three loan programs, so what we're going to do is, to make this a little bit easier to digest both now and in the future, I'm going to walk you through kind of two slides on each of these loan programs. And I'm going to walk you through the key things you should understand, answer some of the common questions that we hear, and help you understand the 8 elements that you see on this slide. Is there an origination? What's the rate? Is it a fixed rate? Is it a variable rate? How much are you allowed to borrow through the program each year? And we'll also talk about how you qualify, whose name the loan is legally in, when you're supposed to start making payments, and what happens if you face some kind of hardship and are unable to pay the loan. And we're going to start off with the federal direct loan. And so let me pause here just to see if we have any questions.
Oh, not yet.
Okay.
I think people are still absorbing it all.
Wonderful.
Oh, actually, here's a quick question.
Yeah.
In order to take Parent Plus loans, do we have to deplete money saved in 529s?
No, not at all. Yeah, easy answer. But thank you for the question. So when you think about paying for college using loans, especially federal loans, you should think of it as a little bit of a decision tree. And if there's any money that you need, you should start using federal direct loans first before you move on to different types of loans. That's the same advice you're going to hear from any financial aid officer or anybody at your school. The reason why you'd want to use this federal direct loan, which is money that is borrowed by the student, is one, among the federal loan options, it's the cheapest. And two, it has a lot of protections that are built into it in case the student graduates without a job or they graduate with a job that's paying less than maybe they thought they would make. And so let's better understand this loan program. And then we'll flip to a second slide, which helps you better understand the amount that you're allowed to borrow through the program each year. So to start off with, both of the federal loan products that we're going to walk through tonight have an origination fee. The origination fee for the money the student can borrow is 1.06% roughly. That's not a fee that you pay out of your pocket, but the way that it would work, to use the same example that we were using before, is let's say that you need to pay $100 to UCLA. In order for UCLA to receive $100, you have to borrow roughly $101.06. And so it increases the principal amount that exists on the loan from day one. This is a relatively small fee. When we switch to the second loan program, the money that the parent can borrow from the government, it's a significantly higher fee. And I'll show you what that looks like in just a few minutes. The interest rate on federal student loans is set by a formula that Congress made up over 10 years ago. I won't go into that, but what's important to know is that for any federal direct loan that you're using to pay for college for this fall, the rate is going to be 6.39%, and that's a fixed rate. There's no credit check that's required for the student to qualify for this loan. The student is the only person who is legally on this loan, and so this would only ever show up on their credit report. It doesn't exist anywhere in relation to the parents. And payments are typically supposed to begin 6 months after the student graduates or drops below half-time enrollment. You might see on your financial aid award letter that there's something called subsidized direct loan or unsubsidized. If your financial aid award letter says subsidized for some portion of the amount that you can borrow through this program, what that basically means is that you're not going to accrue interest while the student is in school. Interest will start accruing at roughly 6 months after the student graduates. If it says unsubsidized, which most do, then that means that you'll start accruing that 6.39% interest once the money is sent to the school, which is typically around the start of classes. I see a question here on what was the interest rate for last year's federal loans. It was about 0.14% higher than what you see now. So it came down ever so slightly year over year.
Maybe one thing also to mention, Chris, is that the interest rate for the direct student loan is set every year, as Chris mentioned that. It's usually determined sometime around the June timeframe. And your student does, if they take this loan every year, they do end up with 4 separate loans, and each loan will be at different interest rates. So
Yeah.
just something to keep in mind. That's, I mean, everybody has to deal with it, but this is not the interest rate, for all those other subsequent loans. We don't know yet what that interest rate's going to be.
Very good point. I see a couple of questions I'll just answer in rapid progression. So at first, I see a question about the interest rate on Parent Plus loans. That's different, and we'll talk about that in 3 minutes. Second, there's a question on why do some people get subsidized loans versus unsubsidized loans? And the answer is that it's based on primarily the results of your FAFSA in combination with the cost of the school. And so when you submit FAFSA, there's a number that comes out of that called an aid index, student aid index. The financial aid office at that school, they take that number and then they have some work they have to do to create a financial aid award package for you and your family. And based on your level of need and a set of rules that they need to follow, they might be able to offer you some portion of your direct loans as subsidized. And if the math doesn't work out, then they will be unable to offer you subsidized loans. And so if you have not gotten subsidized loans, the only way that you could get access would be if you appealed the results of your FAFSA and asked the financial aid office to reconsider how they're running the math. Otherwise, you'll be left with unsubsidized loans. And in order to apply for the federal direct loan, you really just need to have filled out the FAFSA form itself and make sure that it was a completed FAFSA form. For Parent Plus loans, it's different, and I'll walk through that in a minute, but fill out FAFSA. If you haven't done it yet, do it now. Make sure that there's a portion of FAFSA that asks which schools you want the data sent to. Make sure that it is being sent to the school that you're about to attend. Simultaneously reach out to your financial aid office and let them know that you just filled out FAFSA and you intend to use a federal direct loan to help pay for part of the upcoming year.
And again, just to emphasize, having filled out FAFSA is the only requirement that is needed for a student to take out the direct student loans that Chris just walked through. I mean, you could have a ton of money in savings, you could have a really good income, and it doesn't matter. You just have to fill out FAFSA and your student can get access to the loan.
The only downside of a direct loan is the amount that someone can borrow through it. And so what you see on this page is, first of all, this chart shows you the 2 factors that determine the amount that a student can borrow. It's impacted by what year you are in school and by whether or not, in the eyes of the Department of Education, you are considered a dependent student or an independent student. That has nothing to do with whether or not a parent can claim a student on their taxes. It's a more strict definition that the Department of Education uses, and that's what you see on the right-hand side of this slide. And so, to put short, an independent student is allowed to borrow more money from the federal government each year than a dependent student is. But an independent student is limited to people who are at least 24, who are married, who are veterans, orphans, emancipated minors, and a longer list of other attributes that can make somebody independent. Otherwise, you are considered dependent, and a dependent first-year student would be allowed to borrow up to $5,500 for their first year of school, or $6,500 for their second year of school. Very important to note, if you don't use, let's say you are an incoming freshman and you are dependent. You decided not to use the direct loan this year, and in your sophomore year, you want to use the $6,500 that's available to you then, That's all you can use. You can't go back and then access the $5,500 that you could have used in freshman year because it's a use it or lose it program within each year. Okay, I see a good question here that we are absolutely going to talk about. And so let me caveat something with right now we're gonna do a 5-6 minute overview on what Parent Plus loans are. And then we're gonna go into some of the changes that are coming to Parent Plus loans, as well as some guidance on things you can do to keep the better version of the Parent Plus program for future years. And so I know that we have some questions about how you can avoid some of the negative impacts that were just passed into law. And we're absolutely going to cover that within the next 10 minutes. But before we do that, let's just get a baseline on what Parent Plus loans are and how they work for this upcoming year before we flip into how they're going to change for next year and beyond. For this year, the important things to know about Parent Plus loans are that these are meant to help fill whatever remaining gap exists towards your student bill. And so if there's a large amount of money that is owed after the student uses whatever they can access on the direct loan, the Parent Plus loan is there to help fill that gap. It's a loan that is only available in the name of the parent. The student isn't legally tied to this. And as long as you meet the Department of Education's basic eligibility criteria, then you'll qualify, and everybody who qualifies gets the same rate. So let's just walk through some of the key things to know about it, and then I'll answer a few brief questions about it on the next slide. I showed you that the direct loan that's borrowed by the student had a 1% origination fee. Parent Plus is considerably more expensive. The origination fee on this is 4.2%. And so to use the same example as before, in order to send $100 to UCLA towards your student bill, you'd have to borrow a little bit over $104. So your balance increases on day one. Likewise, the interest rate on these is a lot higher than what you saw on the direct loan. So the direct loan rate was 6.39% for anybody going to school this fall. The Parent Plus loan is at an 8.94% fixed rate. The direct loan had that $5,500 borrowing cap for a first-year dependent student. Parent Plus, as I was mentioning before, that allows you to borrow a significantly larger amount of money this year. And so whatever that cost of attendance is, minus the other financial assistance that you've received in the form of scholarships or grants. Now, we're going to talk a little bit more about this on the next slide, but there's an actual application that you have to fill out in order to access a Parent Plus loan. It's not enough to just have filled out FAFSA. So I have a link to that application on the next slide. It's on the studentaid.gov website, which is the same place that you filled out FAFSA. You fill out that application, and as long as you don't have something called adverse credit history, which I'll talk about in the next slide, then you'll qualify. And there's two ways to think about when payments begin on this loan. So there's one option where payments are supposed to start 60 days after the money is dispersed, which is really just the technical term for the day that the money is sent to the school. You do have an option to defer making payments until 6 months after your student graduates from college as well. And so if that is something you want to do, if you want to defer making payments, you absolutely can. Just make sure that you have opted into so. Interest is going to start accruing on these loans once the money is sent to the school. If you want to start chipping away at these loans earlier, you're absolutely able to. There is no prepayment penalty on any of the student loan products that I'm talking to you about tonight. So if you want to, or you're able to start making some lump sum payments or just some regular payments towards any of these loans over time, that can really help in making sure that the amount that's owed upon graduation doesn't balloon out of control. All right, let's go through some of the common questions about Parent Plus, and then I see some good questions that we'll touch on as well in the chat. So maybe the most common question I get is who's actually eligible for a Parent Plus loan? And it is strictly limited to the parents of undergraduate students who are enrolled at least half-time. An uncle or an aunt or a grandparent cannot take out a Parent Plus loan to help a child pay for school. It's unfortunate, but that's just how the program is set up. And a child cannot be legally tied to a Parent Plus loan. So this is something that is only available in the name of the parent. It will only ever show up on the credit report of the parent. The student isn't legally responsible for paying it back. You can have shared responsibility at a family level in a conversation that you have with the student, but that's really more of a handshake and an agreement, and it's not something that is legally enforceable in this loan. In order to get access to a Parent Plus loan, you apply on the studentaid.gov website. And once you apply, assuming you are approved, then there's one more step where you need to sign a document called a master promissory note. And once you do that, then the federal government effectively talks to your school, and your school says, this is the date that we need you to send the money by, and the rest of the process is fairly automated. There are a few reasons why you could theoretically be denied access to a Parent Plus loan. I've included a link to a longer list of what those reasons are, but the terminology that you'll see is adverse credit history, which the Department of Education just defines as things like having defaulted on previous federal student loans, having recent bankruptcies, or having large debts that are more than 90 days delinquent, or a wage garnishment or a tax lien. There are more reasons, but these are some of the, I'd say, more common rationales for why you could get denied. Otherwise, you should get approved. And if you're approved, regardless of what your credit score is or your income is, everybody gets the same 8.94% rate. Good question here. Can you make payments, early payments, even if you initially request to defer payments until after graduation? And the answer is yes. You can always make early payments on the federal student loans. And the same is true for private student lenders as well. Now, one more good question. You do have to apply for a Parent Plus loan every year. And so the amount that you're allowed to borrow through any loan program, whether it's the direct loan for the student, Parent Plus, or a private loan, is always going to be limited to borrowing for one academic year at a time. And for all of these, you actually do have to submit a full, well, for Parent Plus and for private loans, you have to submit a full application each year. And for the direct loan, the money the student can get, you need to have filled out a new FAFSA form every single year. Now, Parent Plus is going to change a little bit starting next year. And so I'm going to walk you through a few brief things to know about this, and happy to answer any questions that people might have. First off, these changes were only signed into law really as of a few days ago. And there's really two buckets of ways to think about this. If you or your children are going to school this fall, then there is a way for you to keep the current version of Parent Plus loans until they graduate. And I'm going to walk you through what that looks like. If your children are going to school next year for the first time after July 2026, then the amount that you're allowed to borrow through Parent Plus is going to be significantly lower than what you can get today. So, as I was mentioning before, today, there is theoretically no limit to what you can get through the program. It's whatever the cost of attendance is each year that the school says, and there's no lifetime limit. And so that's very different than starting next year. If you have a child who's going to school for the first time next year, then you could access up to $20,000 each year through Parent Plus, and a total of $65,000 per child lifetime. And so, to use an example, over 4 years of school, you could borrow $20,000 per year for the first 3 years of school, and then just $5,000 for the 4th year of school. These are very big changes to how things have worked to date, and so they're just important to be aware of. Maybe one really quick example. I know there's a lot of numbers on here, but this is just to put this in perspective. We've been using an example of a family that's going to UCLA, where the student got $5,000 of scholarships and grants, and the family had $10,000 of savings to put towards school for this year. What this slide is really just showing you is over 4 years, if that student then maximizes the amount that they're allowed to borrow directly from the federal government, and then the parent maximizes the amount that they're able to borrow through the new limits of the Parent Plus program, how much unmet need is left at the end of each year. And what you see is, for this example, where a student is an in-state student, so their tuition isn't too high, there's still going to be some unmet need that's left every single year, and a pretty large amount of unmet need in the 4th year of school, because the parent has maxed out, they've hit the $65,000 lifetime cap on the Parent Plus loan. And so this is going to be increasingly important for anybody whose student is going to school for the first time next year and beyond. If you're going to school this year, then there is, say, a rosier scenario here, which is to say you can keep or get grandfathered into the current Parent Plus loan limits as long as there's already a federal loan that's been taken out for before June 30th, 2026. And really, just to be safe, I think the general advice right now is that you probably want to take out at least some minimal amount of Parent Plus loans this year to make sure that you get grandfathered into and keep access to the current version of Parent Plus loans for up to 3 more years after this year. If you don't do this, then there is a chance that maybe you find next year and beyond that you are limited by the new Parent Plus loans for that student. And then unfortunately, if you have any children who are starting college next year and beyond, you will be faced with the new Parent Plus loan limits for those children. And there are many cases in which those loan limits are not going to be high enough to help people pay for the full amount of whatever school costs. And you would need to start exploring what other private alternative options exist. I'm going to pause here.
Yes. Can you go back a page to where you talk about the limits?
Yes.
Just to clarify. Yeah, that's good. It's per parent per student, but is it per household? So like, there's 2 parents, can each of them take 65,000 per student?
Unfortunately not. That's how the loan limit, that's how it was described under an earlier draft of the House bill. But under the version that ultimately passed, think of it as tied to the student level. And so, on behalf of,
so it is really per household per student.
Yeah.
Not necessarily per individual parent.
Yeah.
Okay.
Yeah, great question. So the question here on what's the pro of taking a Parent Plus loan versus a private loan? Two ways I'd just like to answer that. One is there are many people for whom the rate that is offered on a Parent Plus loan is lower than what they'll get quoted on a private student loan. And in that case, it's going to be the cheaper option and you want to use it. And the second is less about this year and more about future years. The reason why it can help it's nice to have optionality. You might qualify for a private student loan this year at a great rate, which is fantastic. But let's say next year something happened and you lost your job and you then won't or are less likely to qualify for a private loan next year or 2 years or 3 years from now, then having kept the current version of Parent Plus loan limits, or at least having access to them, it gives you a lot of optionality and a little bit more breathing room. So I just recommend, even if you're borrowing $100 from the Parent Plus loan program this year, it might seem trivial, but you're just effectively giving yourself an insurance policy that you otherwise won't get.
So, Chris, there's a question about what if a parent has started making tuition payments? Would those amounts be applied towards, the caps that are potentially put in place?
No. So and just to make sure if I'm interpreting this question as, would making early tuition payments to a school count towards allowing you to be grandfathered into or keeping the current caps for longer? I think the answer to that would be no, that as best I could read it. The only thing that allows you to get grandfathered into that's keeping these higher limits for longer is if you likely already have a Parent Plus loan that has been borrowed for that program for that student.
I think actually I might have asked you the question, not the way they actually wrote it, but that was good that you answered that one. But I think the question is really, if they've started making payments, will that reduce the amount that they can take out in a Parent Plus loan?
Yes and no. So technically, yes, it would. Otherwise, the school will, what it effectively does is going to lower your borrowing cap because the student bill, the outstanding balance that exists for that student is going to be lower than what is, let's say, the publicly published cost of attendance. And so once the lender contacts the school to ask how much you're still eligible to borrow, the school is going to say, actually, the amount that's left that this person can borrow is lower than maybe what you're asking for.
Okay, yeah, I think that's the question and answer. Yeah.
So a lot of really good questions.
So
good.
Not to be cynical, but just having, dealt with FAFSA and all of these issues with the government for many years, how do you think the government's going to actually track? So let me give you the situation where parents are divorced. One parent fills out the FAFSA, another parent takes out the Parent Plus loan.
That's a good question. It's not going to impact the amount that I know I'm not answering this exact question, but it's just I'm combining it in my head with another question that I'm reading. There's no situation where divorce or separation would increase the amount of money that a family can get through Parent Plus to help pay towards a single student's education in the future. And so I don't know if I'm answering anything that's out
No,
here.
no, I agree with you. It shouldn't increase the limit. I'm just thinking about the systems and the kind of having a, a little bit of a hypothesis about how things are tracked and wondering if that's going to be tracked well.
It is a good question. It's not dissimilar to issues that currently exist. I don't know.
Yeah, okay. Just I'm going to put it on my list to start asking people that one.
Let's see. All right, I see a lot of really good questions. I want to make sure I can read these. I'm just going to answer a couple of really quick ones, and then just for the sake of time, I'm going to try to go through only the next 10, 12 minutes worth of slides, and then just return to any of the slightly more complicated questions that are definitely worth addressing. And just really quickly, the question here on what is the maximum that you can borrow through Parent Plus? The maximum is the cost of attendance of that school minus the other scholarships and grants that have been received for that program, generally speaking. And Parent Plus loans do need to be applied for every single year. And okay. I'm going to give you the 5-minute primer on private loans. A much longer primer on this is probably warranted, but I want to just give you just a quick 5-minute overview on how these work. I'm going to switch to 5 minutes on how all of these changes are also impacting graduate students, because that is increasingly relevant for you or any of your children who may be thinking about graduate school next year and beyond. And then really just 3 minutes on Juno and back to Q&A. I promise I will do my best to stick to that time schedule. Private loans are, really think of it as today, it's best viewed as a potential alternative to Parent Plus loans for people who can get lower rates from a private lender than what Parent Plus is offering. But in the future, it may, for many people, become something that they need to use in order to fill the remaining need that whatever amount is left on their student bill after they've exhausted what they can access through federal loan programs with lower limits. And so for a lot of people, this might not be relevant today, could be relevant tomorrow and beyond. Typically, the way the market works today, private loans do not have origination fees. I don't know if that could change in the future, to be completely honest. I just know that currently all of the major lenders and any that I have looked at for 7 years do not charge an origination fee. The interest rate on private loans is based on the strength of your credit history and sometimes income as well. So each place that you might check your rates, it could be quite different for somebody with the same exact profile, and would certainly be different based on people who have different credit profiles. The minimum FICO that's required to qualify, it's going to vary from one lender to the next, but it's typically around 650. And most private loans that exist are co-signed by both the parent and the student. So both people are legally on. The borrowing limit for private loans is the same as what I showed you that is the borrowing limit for Parent Plus loans today. And so you're able to borrow up to the cost of attendance minus the scholarships and grants you've received. Nothing in the laws that were implemented changes the amount that this borrowing cap for private loans. So I anticipate that next year and in the future still, private loans should continue to cover the full cost of attendance if needed. But what is more interesting about private loans is that you actually have 3 variables that can impact the rates that you see. When somebody checks their rates on private loans, they typically will get a grid of many different options, even from the same lender. And you'll see different rates. Those rates are impacted by let's say, these 3 things. First, fixed rates or variable rates. And if you're looking at these, I'd say generally go with fixed rates. Second is the payment term. So the number of years that you have to pay back that loan. And different lenders have different options, but it's typically somewhere between 5 and 20 years, and you get to choose. And there's a different rate that's associated with each term. And then finally, you also get to choose when to start making payments. You can always make payments faster than you have selected, but whatever you choose is at least the slowest that you're allowed to make payments back. There's 4 options that you can choose from in these scenarios, and you see them on the bottom right hand of the slide, but I'll just go through 2 of them. On one extreme, you can choose to defer making any payments until either 6 or 9 months after the student graduates. Some lenders allow 6, some lenders allow 9. And on the other extreme, you could opt into something called immediate repayment, which basically means if you've taken out a 5-year immediate repayment loan today, then you should be done paying it off 5 years and 1 month from today, roughly speaking. And so those are the key things to know about private loans. The other really important thing is, whereas the federal loans do have some levels of protection and flexibility around your repayment, private loans generally do not. And so I'd use these in some cases if you're getting a lower rate, but know that you do have some trade-offs. Let me just go through a few of the common questions that we'll get. One is, when would you consider a private loan? And really, only look at this after the student has used the federal direct loan. I'd still always recommend using the federal direct loan first. If people have questions about why, I'm happy to answer those at the end. 3 reasons why you might consider using a private loan. So the first is, we talked about how Parent Plus is only in the name of the parent. The student's not legally attached to it. And so if you want a loan that is also in the student's name, then it would currently have to be a private loan. Second reason is, depending on your credit, when you check rates, you might get something that's meaningfully cheaper than Parent Plus, and then consider a private loan. And the third is, starting next year, if you do hit a Parent Plus cap and you need more money, then a private loan at that point would be the only option. And just one word of advice here is that most lenders now allow you to see what rates you might qualify for without doing a hard pull on your credit. And so there's ways that you can go about checking what options are available to you and shopping around. I highly recommend shopping around. You never know what you're going to get from one place to the next, and it can change from 1 week to the next. All right, I'm going to give you 3 minutes on graduate loans, and then 3 minutes on Juno, and back to Q&A. So we have much longer and more detailed presentations about graduate student loans for anybody who might be curious. Juno started in the graduate student lending business, and we're today the most popular way to pay for most law schools and MBA programs. There's 2 options that you have for federal loans for grad students today. And so if somebody was going to, let's say, UCLA Law this upcoming fall, then they could access a direct unsubsidized loan. That's the first one, and something called a federal grad plus loan. And so is they could access $20,500 from that first bucket of money from the government. And if they needed more than that, they could get whatever additional amount was needed up to the cost of attendance from the grad plus loan program. Now, unfortunately, starting next year as a result of this bill, that is going to change considerably. So next year, for new students, there will no longer be a grad plus loan program. At the same time, the limits on the direct unsubsidized loan are going to change a little bit too. And so if you're listening right now and you have children who are going to school next year or beyond for grad school, if they're going into a master's program, they will only be allowed to borrow $20,500 per year from the government. If they're going into a professional program, which is defined as law and many medical professions, then they'd be allowed to borrow up to $50,000 per year from the federal government. If they need more than that per year, then their only remaining option starting next year and beyond would be private loans. And so it's similar to kind of what we've just been talking about with Parent Plus. This overall plus loan program for grad students is being completely sunset. However, similar to the grandfathering that we talked about for the Parent Plus loan program, there's a grandfathering exception for graduate students too. And so if you happen to have a student or know somebody who is going to be in graduate school this fall, then it's important for them to use some federal student loans in order to keep access to the existing versions of the Grad Plus loan program for up to 3 more years or until their program completes. And I'm going through this a little bit quickly, but if you have questions about graduate student loans or really anything related to graduate financial aid, please don't hesitate to reach out to me directly. Our team spoke to, I think, somewhere around 1,000 people, primarily at MBA programs and law schools last month alone, just about these topics. Finally, just a really quick plug on how Juno fits into this overall process. And so I was telling you that 7 years ago, I started Juno with one of my classmates to see if we could change the rates and terms that were offered to a group of people. And it worked really well. Today, we do the same exact thing, but for a little bit over 200,000 people. And as a result of having a large member base, we're able to get lenders to offer things to our member base that would be difficult for us to access on our own. There's a link on this slide, and I think Debbie has shared it before as well. If you have 2 to 3 minutes to spare at some point in your process of shopping around, I would ask you to just check your rates on Juno. We have 2 versions of loan offers that are available to people going to school this fall. For undergraduate loans, if you check your rates and you use a loan with our funding partner there, then we're able to give you 2% of that loan as cash back. If you find a better rate somewhere else, honestly, that's great. And we have a very simple process where from a very long list of competing lenders, we're able to match those lower rates if you find them and increase your cash back to 3%. For graduate student loans, it's a little bit different, but we have a few different funding partners there. We are very successful at having the lowest rates in the graduate market. We have one of our partners has lower rates if you go through Juno than if you go directly to that same lender itself. And another one of our partners has extremely low rates, especially on 15-year loan terms, and we're able to give you some cash back on that as well. And there's a rate match program again. And so I saw that Debbie posted the link as well. You can check your rates pretty quickly. And our goal is not to ask you to trust us that we can put a great product in front of you, but to create a process that makes it virtually guaranteed that you will have the lowest cost outcome if you just give us a chance in the process. And so I am actually telling you to shop around to see what lower rates you can get anywhere. If you find something that's better than what we've been able to put in front of you, whether it's for an undergrad loan or a grad loan, all you really need to do is email hello@joinjuno.com, and someone on our team can walk you through just step by step how to claim the rate match and get your cash back. There are no gotchas. This is meant to be as easy as possible. I was looking earlier today, and several hundred people have already done this. So I'd recommend that you just give it a shot as well. Finally, just a few really quick promises from the Juno side. There's no cost to sign up to or use Juno. We're set up as a member organization. We want to lower the barrier so we have more members who join so that we're able to have more leverage in negotiating offers from lenders. There's no hard credit check to see what rates you might be eligible for on Juno. There's only a hard credit check when you submit a full application with any of our lending partners. But in order to see what you might be eligible for, you can do that with just a soft credit check. And none of the lenders that we allow into our marketplace charge fees like application fees, origination fees, or prepayment penalties. And they all have an option to not make any payments while you're in school. Finally, whether you use Juno or not, you can use our team and our one-on-one resources all year round on email, phone, or Zoom for anything related to financial aid, reviewing financial aid appeal letters, or understanding more about student loan options. And I will leave it there. All right, I see I have quite a few questions. Do you have anything you think I should hit first?
Gosh. How about the timing of applying for a Parent Plus loan, timing of applying for private loans?
Yeah, good question. So work backwards from tuition due date. So applying for a Parent Plus loan, the general advice that you'll probably hear is that you want to do whatever you're going to do at least 30 days before the tuition due date. I think that's generally good advice, but I'll give you some math based on what we've seen over the last 3 months, on at least on the private loan side. You can check rates through Juno and at lenders directly, typically in less than 5 minutes. In order to make sure you can get those rates, you have to submit a full application. That takes you another 15 minutes. Once you submit that full application, at least with Juno's partners, about 50% of the time, if you're going to get approved, you get approved same day, 95% of the time within 3 business days. And so now we're saying you can kind of get to the point where you have an approved loan in 1 to 3 days. There's only one more step after that for you, which is that you electronically sign the loan, and then the lender contacts the school and just asks, is this a student at the school, and is the amount that's being asked to borrow less than or equal to the cost of going to the school? And then the school says yes and yes, and please send us the money on this date. And so you can actually get pretty close to the tuition deadline with most private loans, and as long as you're approved, the money will get there in time. And it's relatively similar for Parent Plus loans too. So if you have the time, start at least 30 days before your tuition due date. If your due date is approaching more quickly than that, I'd say don't worry too much, because you likely still have time as well.
Chris, I don't know if you addressed this when you were talking about the changes in the bill, but is it true that in the coming years, a student will have to have maxed out and taken the full amount of the direct student loan before a parent can take out a Parent Plus loan?
Really good question. I need to double check on that. I know that that's how the initial draft of the House bill was written. I didn't think that was how the final version that passed was written, but let me double check on that.
Okay. The only reason I'm asking is because people are asking for this year, like, does their student have to take out the direct student loan in order for the parent to take out the Parent Plus loan? This year, that's not the case under the current, guidelines. I don't know, as I guess what Chris and I mean, this is also new. We don't know for sure. Even if somebody is grandfathered in, will they will if that is potentially a new requirement, I don't know if how that will apply to grandfathered people or not.
That's a very, very good question. Okay.
So we've got some research to do too.
I see a question here on the loans through Juno. Can you start making payments before they are due? Short answer is yes. And just to honestly repeat this, because it is valuable, you can make early payments on the federal direct loan that's borrowed by the student, on the Parent Plus loan, and on any private loan that is currently on the market without facing any fees or trouble. And so really prepayment penalties are what the term that would be used in lending that would prevent you from doing this or put a cost. Those just don't exist today.
Chris, there is a question, again, kind of related to grandfathering. If a parent takes out the Parent Plus loan this, for the 2025-2026 academic year, and technically they should get grandfathered. Does it matter if they end up paying off the parent loan, like in that same year?
So this is a really, really good question. The way that I read the law that actually passed, it should not matter. It says that as long as that there's been a federal loan dispersed for that program of study, meaning for that school, before June 30th, 2026. I've seen some people misinterpret this in articles from some news sources saying that you have to have an outstanding balance as of June 30th, 2026. And so what I would say is there could be a little bit of gray area in how this law gets implemented over the next 12 months. And so while I have a strong belief that it's okay to pay it back early, there is some chance that the law gets implemented slightly differently than it's written. And maybe when somebody at the education department is saying, okay, what set of user IDs are we going to allow to be grandfathered? They might just be looking at whatever the outstanding balances are as of a certain date. Because I want to leave you with something that's actionable, it might just be best to leave a very, very small amount of outstanding balance on Parent Plus as of June 30th, 2026.
And talking about like the amount of the Parent Plus loan, I honestly haven't found the language directly myself. I've just been told this from other colleagues. What is the minimum that a parent can take out in a Parent Plus loan?
I think it's $100 per semester or per academic term. Have you heard
Okay,
any?
I did see that someplace, but somebody also had mentioned $500. So just wasn't completely sure.
It's a good question. I was looking it up over the weekend, and I stopped looking after I saw the 500. That was published on school's financial aid website, but I couldn't actually find the minimum published on the federal student aid handbook.
That I couldn't either. That's why I had started asking people. As you can see, first of all, we don't people don't normally think in this manner because they're not trying to just take out Parent Plus loans, but everything has changed so much this year.
It's a very good question. I was surprised that it didn't exist in the handbook.
Oh, somebody, this is a good question. Somebody said, I saw on the first slide you mentioned about state loans. How do you know if your state has loans that are available?
Oh, really good question. So there is a section of the studentaid.gov website that provides links to the state financial aid websites. So honestly, the easiest thing for you to do right now would be to research whatever state. If you're going to school in state, then you are potentially eligible for state financial aid programs. If you're going to school out of state, it's significantly less likely, but sometimes possible. Research the financial aid program for the state in which you have residence. Uh, Almost all states have a website dedicated to this. And then honestly, just go and look at what the requirements are to qualify for state-based financial aid. Some states have their own loan programs. Some have grants and scholarships that you can qualify for. Some of those qualifications are automatic based on certain criteria. Some of them have to be applied for. And in some cases, you have to list your school in an in-state school on the FAFSA form in order for the state to consider you for state-based financial aid. And so, but those rules are relatively clear on both the same site that you'd fill out FAFSA on, as well as on the individual pages for each of those state programs. Each of those programs does also tend to have its own deadline. Some of them are rolling in year round. Some of them have already passed. I'm sorry, I'm not giving a very actionable answer right now, but I'd say step one would be to just Google the name of your state and financial aid program.
Here's another good question. Can you apply for a Parent Plus loan, like, with an estimate of what you think you need and change the loan amount when you actually get the bill?
Yeah, so if you applied for more than what you're eligible for, then what ends up happening is that the school tells the lender, whoever it is, whether it's the federal government or if it is a private lender, that they need to reduce the lending amount, the loan amount, to whatever your borrowing cap actually is. And then it automatically gets reduced before the money even gets sent to the school. If you want to increase the amount, you can do so before the money is dispersed to the school, meaning before it's actually sent to the school. But there's sometimes a limit on the number of days before that happens, during which you need to do it.
There's been a few questions about for a Parent Plus loan, where is the money dispersed? Is it given to the school or to the parent or the student?
Good question. So the flow of funds is pretty similar, whether it's a Parent Plus or a private. The money is going to get sent directly to the school for all student loans. And then the school is going to apply the mandatory fees and tuition out of that amount first. And then whatever remaining amount exists is going to sit in an account that the student is typically able to access. Most schools will call it a bursar account. Financial aid office typically sends an email saying that there is an overage. They can log into the bursar account to see that overage and then transfer that money to a personal account to use for things like rent and food and books and supplies.
Okay, here's another question. I love, honestly, we're all helping each other. The parents kind of thinking of different variations. So somebody is asking, can I be on the college payment plan and have the loans dispersed to pay, on the plan?
Is the question here about syncing the loan disbursements to the planned payment dates?
It sounds like it, yes.
That's a very good question that I haven't seen done before. I don't. Let me know if you've seen it done before. I don't think that's particularly likely to be able to be done unless you were applying for a sequence of Parent Plus loans with different disbursement dates. But if you just applied for one Parent Plus loan for the full year, it's possible. Don't get me wrong. Don't know if the school would be set up in a way to tell the financial aid, the federal government, to send X amount of money on these dates multiple times.
Yeah, I'm not 100% sure why you would want to do that now that I think about it, because there's usually a little bit of a charge to go on a payment plan. So, you're kind of borrowing plus paying that charge. I mean, I guess the only value would be that you're not being charged interest on the full amount because it's not dispersed all at once, or at least for that semester.
Yeah.
So, a question about it. This is an example of a state loan. In New Jersey, they have New Jersey class loan. Is that the same as the Parent Plus loan?
Good question. No, that is different. So a few states do have some have loan programs that are available to people across multiple states. Most have who do have some kind of program only offer it to residents of that state, or in some cases, people who are studying in that state. The best example is one that you can access through Juno. At least the best example, in my opinion, because what the rates are at is Brazos. And so, if anybody who is listening and is a resident of Texas, or whose children are going to school in Texas, you would be eligible to use something called a Brazos student loan, which you can access through Juno, and at least at the moment has the lowest rates that I've seen.
So what's your recommendation, Chris? Somebody saying they have very good credit. They think that they can qualify for a lower interest rate loan than the parent than the as a private loan compared to the Parent Plus loan, but should they still take out in maybe in the minimum amount a Parent Plus loan to be grandfathered in, even if they end up taking out the private loan because that has the lower rate?
Yes, and I'm going to combine this answer with another great question that I just read, which is, can I take a Parent Plus loan only for the second semester to be grandfathered for future years? Because this bill was only passed less than a week ago, and there could still be differences of opinion in how what is written in text would be interpreted and implemented by the Department of Education. I'd say that to be on the safe side, you should borrow whatever the minimum is from Parent Plus to keep eligibility for the new version or the old version of Parent Plus in future years, where you might need it or you might not. However, the way that it's written, and this part is pretty black and white, you don't have to take Parent Plus out for the fall semester. You can take out whatever minimum amount you'd want in the second semester, as long as a loan has been dispersed to the school before June 30th, 2026, then you meet the rules for being grandfathered under the current version of the Parent Plus loan program.
I guess this is a similar question. Should I apply for a Parent Plus loan and a private loan and then reduce the Parent Plus loan by the amount of the, sorry, and reduce the, wait, should I apply for a Parent Plus loan and private loan, then reduce the Parent Plus loan amount if the private rate is better? So it's a little bit of a process question, meaning like, should somebody apply for both of these at the same time, with the same amounts, because and then adjust the amounts when they get the rate from the private lender.
I'm not sure exactly the best way to answer this. I just say, look, if you're going to apply for Parent Plus, it would be, you know what rate you're going to get on that. And so I would start off with applying or checking your rates on the private loans, seeing if you're getting quoted rates that are good enough to warrant submitting a full application for a private loan, which will result in a hard credit check. If you are seeing rates in the private market that are better than what you're getting on Parent Plus, then yes, you can go ahead and do that and apply for a Parent Plus loan to get whatever minimum amount you want to get from Parent Plus to keep the optionality and grandfathering. Otherwise, if the soft checks that you're doing on private loans aren't resulting in rates that are better than what you'd otherwise get on Parent Plus, then there's not really a point in moving forward with a private loan full application that will give you that hard credit check.
This is just a quick deviation from questions about loans. Do you know, Chris, for a graduate student who is considered independent on FAFSA, are they, can they be claimed as a dependent on a parent's taxes?
I am unqualified to answer that question because there's a lot of reasons why someone can be declared independent that go beyond age.
No, but as a graduate student, I mean, parents aren't filling out the FAFSA, so every graduate student is in theory kind of independent on FAFSA.
On FAFSA, they're all, yes.
Yes.
But it was a question that could they, in theory, also be considered dependent on
Right.
taxes?
Right.
In theory, yes, there are certainly scenarios in which that could happen. Yeah.
Okay. I don't know if we really addressed the question about for private loans, do you have to apply for the full year amount or can you apply just by semester?
You can apply by semester if you want, or you can apply for a full year up front. I generally recommend applying for full year for two reasons. One, whatever amount you apply for the full year is split up amongst the number of academic terms that exist anyway. So if you applied for $20,000 for a semester system, $10,000 is set in the fall, $10,000 is set in the spring, and you're only accruing interest on the amount of money that the school has already received. So you don't accrue interest on the full 20K on day one. You're only going to start accruing interest on the 10K at the second half of that in January when the money is sent for, let's say, the spring semester. And so some people often will say, I want to do semester by semester so I can delay the amount of interest that's accruing. That's happening anyway. The second reason is you're locking in a rate today that rate is going to be the same for the amount of money that's sent in the fall and the amount that's sent in the spring. In some ways, you're giving yourself an option. If something crazy happens and the let's say overall rates go much lower over the next 4 or 5 months, technically you're able to cancel the second disbursement of that you've already secured for the spring and try to see if you can get a lower rate for that term in the future. And so in some ways, you're just giving yourself an extra option at a known cost that you don't actually have to use if you decide that you find something better.
Here's a good question. I don't think we directly addressed. And I'm assuming this is from coming from a parent who has existing children in college. If they took a Parent Plus loan out for a student in a previous year, do they have to still take it out for the 2025-2026 academic year to be grandfathered in?
If it's for the same program, no. And same program would mean same college. in this case. So as long as there's been a loan that has been dispersed for that program already, then you're good.
Can a 529 can 529 money be used to pay down a Parent Plus loan?
I know up to 10K of a 529 plan can be used to pay off a student's loan without a tax penalty. I honestly don't remember off the top of my head if that's also going to apply to a Parent Plus loan.
I don't know either.
Because in that scenario, it would need to be a 529 for the parent, not for the student. And can the parent use that to pay off? I have to think about that for a second. It's a little bit more complicated. I know I have the answer. I had just researched this a few weeks ago, so I'll go back and look it up.
A question I haven't seen is somebody's asking, Chris, how is Juno different from a credit union?
It's a good question. A credit union would typically have you open an account, put deposits in. We don't do any of that. I'd say I'd consider us more similar to AAA or Costco, to be totally honest. Our goal is to help get you access to whatever the best version of a student loan product is that we're able to find. And if it works for you to use it, and if it doesn't, you don't need to use it. It doesn't matter. So you can honestly just think of us in some ways as an organization that puts together a waiting list once a year. And that wait list is meant to collect interest from people who might need a loan for the upcoming term. And then in June, we open that wait list and just tell you what the best thing is that we've been able to come up with. And that cycle repeats year after year.
Another question about grandfathering. Somebody's asking if they have two children, one who is going to be starting college in fall of 2025, and they take out the Parent Plus loan just to make sure that they're grandfathered. Does that grandfathering also apply to a younger student they have that might start college in 2028?
This is a really good question. Unfortunately, the answer is no. The grandfathering only applies to that first student. There's no way for that to continue on to future students.
A question about people who are going to Juno right now, asking, do they put both the child and the co-signing parent information to get the rates?
You can. So yes, in short, you don't have to. And so once you get to a page that'll ask you to do a rate check, you can either apply with or without a cosigner. And so the parent can typically check rates without a cosigner and they'll still see something. But sometimes the student will fill out the first section of it and then they won't necessarily fill in some of the information that's needed at the bottom of the screen for a cosigner. In those scenarios, it's quite rare for them to actually see rates. And again, it's primarily because 98 to 99% of all undergraduate private loans are co-signed, and typically need to be because the students by themselves I don't have long enough credit history to meet the eligibility requirements of almost all lenders.
Another question about grandfathering, which is, these are all important just to clear up. We mentioned how you need to take the Parent Plus loan out for the student at a particular college. So what if a parent takes the Parent Plus loan out for the student at college A, but the student actually transfers in a later year to a different college?
Uh, this is a really good question that there's not a clear answer to that I've been able to find yet. I don't know if you've heard anything different, if you've seen this question yet, Debbie. My belief is that it would likely be okay, but I don't have definitive proof yet.
Yeah, myself as well. I haven't read any specific lines that address this situation, so yeah, it's hard to give a good answer.
I'm 99% sure that this scenario is not spelled out in the legislative text. And so it will ultimately be based on how it gets implemented and interpreted. And so we won't really know yet. But the reason I say that I think ultimately, I'm assuming that the transfer would be happening in the fall of 2026 in my answer. And so I think there'll be a date on, let's say, June 30th, 2026, where a student would basically get flagged in the system as, okay, is this student going to fall under the old rules or the new rules? And then after that, if they transfer, they'll probably be carrying through whatever was decided on June 30th, 2026. I could be wrong, but that's how I'm assuming it will be have to get implemented.
Somebody is saying, I have the estimated cost of attendance, tuition, housing fees, etc., aren't applied to the student account until the end of July. Should I wait to apply for parent loans then or start now? I don't want to come up short in the end for funds.
My general advice is to start earlier if you can and slightly overestimate what you might need, knowing that the school would automatically reduce the amount of the loan to whatever the ultimate bill is. And that if you then still didn't need as much as what you technically borrowed, you can pay it back early without a penalty. Some schools have a shorter window between when they publish that bill and when that bill is actually due, in which case what I described is more important. Some schools will publish the bill 45 plus days before it's actually due, in which case you're typically more than fine to wait until you get the bill in order to take action. And so there's no one size fits all answer here. I would just say make sure that you're starting at least 30 days out. And that's it.
Okay, I think we answered most of the questions. I would encourage people, besides, setting up a free account at Juno, to also watch out for sessions that we have coming up in the next few weeks, because as you kind of get into the process, if you still have questions, you can come back, ask the questions. You can also use the helpline at Juno to get any of your questions answered. So don't expect that, everything you heard tonight is the only help you can get. There's still lots of other ways that you can ask questions. In fact, we also have a chat group in the Paying for College 101 Facebook group, and it's actually called Student Loan Chat, and people from Juno are in there as well answering questions. So feel free to reach out lots of different ways.
Thank you, everybody, for being here tonight. And thanks, Debbie, as always, for inviting me to join you as well.
Absolutely. I never thought, like, year after year, this process would get crazier, but it unfortunately seems to, So sorry about that, everyone. I thought, who knew that all these changes would be coming. Okay. Good night, everyone.
Right.